everyone. Welcome once again to our new segment called The Turning Point from Bird Traps Report TV. Today, we're with Larry McDonald, our CEO, and of course, our longtime contributor, Robert Van Battenborg. Guys, what's happening today? Tell me.
Well, the first thing that in our next book, When Markets Speak, there's a scene in the book where we talk about the rate of change in oil, in copper, in interest rates, and in transports. And so these groups, when the rate of change of these groups and when the correlation rises with these groups together, it typically means something, especially in the back of a very disturbing earnings season. So, we're always listening to markets, and there's some very big things happening this week with the move in oil, the move in the long bond in terms of interest rates coming down, the move in copper, the move in the transports, move in natural gas. So commodities are moving very fast, like the rate of change is picking up. The underperformance versus, say, the NASDAQ is pretty spectacular. And so it's very similar to January, February of 2020. When an economic shock comes at the market, typically what people do is they run into defensive areas, things like the NASDAQ, the Qs, the Apples, the Microsofts, the Googles. And so when you see a sharp rate of change or a sharp deterioration in economically sensitive sectors relative to hideouts, it typically means something. It meant a lot in January, February 2020 because parts of the market could see that COVID risk coming at us. And I think that something's going on in the market today. Jose, can you pull up the first chart? And so what we've noticed this week, and Robert has a model that tracks all the commodities versus equities, and we're looking for those sharp changes. As you can see there at the top right of your screen, the vertical nature of that move, this is the Qs outperforming the BCOM, the Bloomberg Commodity Index. That's one of the sharpest moves in the last year, and it's pretty rare. You do get some spots through the year where this happens, but in that short period of time, you look at 5-6 day window where commodities are underperforming that much economically, and on top of that, the transports are underperforming the S&P by 10% since July. So economically sensitive areas of the market are telling you something's happening. And then when we look at the earnings season, you've got all kinds of companies, Whirlpool, Macy's, Nordstrom's, very soft outlooks over the last 6 months. But in recent weeks, you've got other companies that are even more exposed to the consumer that are warning. Even today, Upstart is a subprime lender. So we've got a lot of companies that face consumers as showing softness, and then here you've got a sharp rate of change. Jose, next chart. I want to bring in Rob. Rob, so when you were running the data, tell us some of the things that you were seeing. Let's have a conversation.
Yeah, like we discussed, one of the big standouts this morning was a company called Ahold in the Netherlands. Many people may not have heard of it, but they have a big exposure in the US through Stop and Shop and Giant and Lion Food Market. So their sales in the US is $55 billion per year. And,
55 billion?
55 billion.
Oh, wow.
So what's special is that retailers in the US still have to report. Like most big companies have, I think, about 80% in terms of market cap of the S&P 500 have reported, but the retailers have not. They're going to start reporting in the middle of the month, starting with Home Depot, Target on November the 15th, and Walmart a day later. But Ahold in the Netherlands doesn't work off that schedule, so they reported this morning. They were warning about weak consumer trends in the United States. They were complaining about SNAP benefits dropping off. They were complaining about higher financing costs. They were complaining about the resumption of student loan payments, all headwinds on the consumer. And that came on the back of some heavyweights in the US also reporting a couple of weeks ago, like Facebook, Meta, said that they saw a significant drop-off in advertising spending in the beginning of October. Some of that may be related to what's happening in the Middle East, but Equally interesting was is that the bears in South Africa reported a significant drop off in diamond sales since the beginning of October. So we're definitely seeing some pressure on the consumer here. Now it's not all synchronous, right? There's some standouts. Some companies still do great, like Deckers or the American Eagle or Abercrombie, but by and large, a lot of retailers have been hurt by these mounting headwinds on the consumer.
Yeah, and I think, if you look at that on top, so if you look at the earnings season and then you look at this BCOM chart versus the Qs, you can see it's very similar to pre-Lehman, pre-COVID, where an economic shock comes at us. The Fed is starting to tip their hand at a softer path because they're seeing something under the surface that bothers them. So rate cuts are now being priced in the market. And as you can see there, commodities are being, sharply underperforming kind of safe haven stocks. And that's like your first that's the first thing that happens before a sharp economic downturn is the money has to go somewhere, and it typically goes into some of the hideouts. Next slide, Jose. Yeah, so Rob ran this data yesterday, and as you can see here, the underperformance of Brent. I mean, you think about what's happening in the world, multipolar world, tensions in the Middle East, and the breadth of the Brent underperformance here, Rob. Relative to the potential shock, you still have threats in the Middle East. And so you can tell here there's more of a flight to quality. What was your takeaway when you ran this data last night?
Yeah, well, so you have the confluence of significant decline in the price of oil. It's about 15, maybe more now, 60% over the last 10 trading days or so, combined with a big rebound in overall equities. And I think some of the oil risk premium is seeping out of oil, right? So we're picking up noise that U.S. and European politicians are now behind the scenes pressuring Zelensky to move towards some sort of talk of a peace deal with Russia. Biden obviously doesn't want the Ukraine war during an election year. The counteroffensive didn't do anything. And European politicians and the House in the United States is also nickel and diming the administration on further funding for Ukraine. So there needs to be some sort of phase out of that. And that is part of the oil premium that is seeping out. With respect to the Middle East, that is still a very uncertain situation, of course, but we've seen pressure on Israel to have some sort of ceasefire. This morning we saw Qatar as an interlocutor getting closer to a deal to release some of the hostages there. So slowly but surely that's also moving towards the background. So for the time being, especially in a period of time where demand for oil is relatively subdued, right? You're in between summer peak driving season and Thanksgiving. So right now the demand is really not there. So that oil is basically hitting an air pocket.
Okay, that's really helpful, Rob. So, once again, we noticed this sharp underperformance of oil right before COVID and before other economic shocks, and it's also, you said, seasonally you have some of this dynamic too, where you get weak performance in this part of the year. Okay, next chart, Jose, and this is just a follow-up. This is your rate of change of BCOM, which is the Bloomberg Commodity Index, versus the NASDAQ. You can see it's one of the sharper moves. There's been bigger moves, and this is over a 1 week period. And so that's kind of telling you something's happened there. People's capital's moving out of commodities into safe havens inside the NASDAQ. And the breadth in the market deteriorated a lot over the last couple of months. It improved Friday, but then you didn't have any follow-up this week. So you had a lot of new lows versus new highs in the NASDAQ over the last month, and more people are hiding out in fewer and fewer stocks. Next one, Jose. Okay, and this is just, Rob, this is looking at Stop and Shop, Ahold. your dramatic underperformance there. You can see it's similar to it's similar to the commodity place where capital is pouring out of retail-facing companies and into what are perceived safe havens.
Right. Yes, exactly. And we've seen that not only with cyclicals like Ahold, but we've even seen it with other defensives like staples or utilities. I mean, one of the more remarkable developments over the last couple of days has been that utilities underperformed, even though we've seen an epic rally in the rates market. So treasury bonds went up a lot, of course, from very low levels, but utilities and real estate and to a certain extent staples are a derivative of the treasuries. So when treasuries go up, utilities tend to go up as well, because the same group of people that buy utilities, the same group of people that buy real estate are buyers of treasuries because they're in search for yield. But utilities continue to underperform, which is quite astonishing. Normally, in a kind of an environment of significant slowdown economic growth, that capital is hiding out in utilities. It goes into staples. They're insulated from big headwinds. You're not going to stop buying milk. You're not going to stop paying your utility bill unless it's really bad. So, but so far we've seen a very, very, very muted reaction in those traditionally very defensive sectors, and that capital going into NASDAQ, it's almost a substitute and big heavyweight NASDAQ stocks for utilities and real estate these days.
Yeah, and once again, before COVID, before Lehman, we saw rates coming down fast, the rate of change of interest rates coming down in the 10-year, the 30-year, the rate of change of oil coming down, copper, the underperformance of transports. When you add it all together and then you look at the earnings season of companies that face consumers, when you add up that whole picture together, something happened in September. You get student loan payments coming in, about $300 a month for 41 million people, and something's happening. A lot of consumer-facing companies are showing more pain. Jose, next one. Okay, so here's an example of a flight to quality. In the chat, so we run a Bloomberg chat with about 600 institutional investors in 23 countries, and as you can see here with Apple, they guided lower, 4 consecutive quarters of falling sales. You've got a company that's trading at 7.3, 7.4 times sales. Historically, it's traded at 1 to 3 times sales. So once again, you've got this RSI down the bottom, the daily rate of change. That's one of the sharpest. We went back 3 or 4 years, and that's one of the sharpest moves on record. I'd say it's in the top 10, and that's where we're tracking the daily RSI. That's how much Apple was oversold. So he went from just below a 30 RSI to something in the 60s inside of a week. Very unusual, okay? And typically, when this happens, it's not a very sustainable move. We went back and we looked at some of the data. When you have that sharp, as you can see there on the left side of the screen, in March of 2021 into 22, you can see it on the left side of the screen, you had that sharp move up, sharp rate of change, and then a rollover. Another problem with Apple here is you're coming back into that supply channel, and a lot of baby boomers, a lot of people are in the market, dead money for 2 years in a lot of these tech stocks. The media makes a big deal of these companies this year, but they're just coming off destroyed levels in 2022. But at the end of the day, in most of these stocks, Amazon, Netflix, Meta, you're dead money for 2 years. Interest rates are much higher now than they were a couple of years ago. You don't have QE. You're coming into supply. You're coming into the 100-day moving average. And so this stock and a lot of these big names have had trouble here. So I think this all adds up to looking forward, not backward, looking forward. The rate of change in oil, the rate of change in copper, the rate of change in interest rates, the transports underperforming the S&P by 10% since July, and then all of these earnings misses in companies from pet food and Chewy and all along, from toy makers, Hasbro and Mattel, Whirlpool, companies that face middle-class consumers are in a lot of pain. And on the finance side, in subprime lending, we're seeing a tremendous amount of warnings there. So I think it all sets up for a softer patch in the economy. People the flight to quality in the stocks like Apple, and people are hiding out in these stocks. You're probably going to have a mean reversion where these hideouts really kind of catch up over the next couple of months, which should bring down the indexes between now and say February. Next one, Jose. Okay, and the last one, these guys reported last night, SANM, and it's just, I can tell you, I've gone through in the teams. You can literally find 100 plus of these charts. You're talking about $2.5 billion market cap company, $9 billion of sales. Company faces a major amount of the U.S. industrial base, and it's just showing warning. The CFO made a comment around guidance for the first half headwinds, and you're seeing just over and over again CFO after CFO of companies in not only the semiconductor space, many parts of technology, many parts of the consumer-facing space, just more and more earnings warnings relative. Don't forget, the S&P earnings, the street's up at $240 for 2024, $240. And so if you take a multiple of 18 times that 240, 238, you should be somewhere near 4,500. But if that multiple comes down and all of a sudden the earnings are 220, 210, because of all these earnings warnings looking forward, then all of a sudden you're down near 31, 32, 300, 3,200. And then if you take the multiple down to 15, in a multipolar world with higher rates, historically the last 70 years, you've had a much lower multiple than you have now. Robert, any closing comments on this dynamic?
Yeah, no, I think we will continue to see, especially when retail season is starting in the middle of the month, we will continue to see a lot of retailers giving up a quite cautious outlook, especially since consumer spending trends have pulled back so significantly towards the end of September and the beginning of October. Redbook retail sales came out yesterday. They slowed down also significantly. So it's going to be very interesting in that retail season which companies can hold their head above water. We've seen companies like Walmart and Costco still staying very strong. We talked about this already with Larry, that a lot of that capital that must be exposed into retail, they're going into the leaders. So Walmart is an obvious one, Costco as well. But it's going to be a minefield. So the next couple of weeks for retail earnings is going to be very interesting.
Yeah, every time there's an economic shock, like say in restaurants, people flock into Chipotle and McDonald's, whereas the rest of the restaurant group has dramatic underperformance. Just like you said with the retailers, you got Walmart near an all-time high, but then you have all these other stocks that are 40, 50, 70% off the highs in the retail space. So capital a lot of times has to stay in a sector. A lot of these long-only mutual funds, they have to stay invested. A lot of these passive accounts have to stay invested. And so the money just flies into fewer and fewer names. And that's typically what you see before some type of shock. And then I just close with Target, the CFO. Target's had some company-specific problems, but the CFO made a comment Thursday, Friday around like people just buying less items. Like we're talking, this is nothing to do with woke or anything like that with Target or the company. It's just people that coming into the store are buying less items. And that's that financial pressure from interest rates, higher interest rates on auto loans, higher interest rates on mortgages. All that's putting pressure on the consumer. But Valentina, why don't you kick it off? In terms of saying goodbye, and we look forward to seeing everyone on the next segment.
Thank you, everybody, for joining us, and thank you guys for all of the insight. As Larry mentioned before, we run an institutional Bloomer chat. We have more than 660 investors. If you want a free trial to that or just to our reports, reach out at Valentina at theredshopsreport.com. That's Valentina at theredshopsreport.com. And remember, you can pre order our upcoming book right now. You can find the link in the description below. Thank you so much.